Good afternoon. My name is Mario Becker. I'm the founder and CEO of Das Family Office, a Singapore-based multi-family office and fund management company. And in the following video, I'm summarizing the events of the second quarter. I hope you're finding it useful. Dear clients, friends, and stakeholders, today's video is from Lake Como in Italy because I'm spending a couple of days here with my family and not from Singapore. But given the volatility in the markets and given the concerns that many of us have, I decided to move on quickly and give you a quick update as to how we're looking at markets. Unfortunately, we had another bad quarter in the second quarter. I was hoping for a bit of a reprieve, but that wasn't meant to be. We've seen losses across the board in all major asset classes except for commodities. This is very disappointing, especially also because global investment grade bond markets have been selling off to a degree that we have not seen in decades, or if ever. If you're looking at long-dated government bonds, they've lost much more than the average global equity market. And this is very concerning, especially also for our conservative investors or investors that may have used leverage to increase their returns. They have seen a significant change in environment and need to respond accordingly. We've seen high double-digit losses pretty much for all investment-grade bond categories. High-yield bonds didn't actually lose more. Also, Tier 1 capital performed comparatively the same, which is also a bit of a surprise. Normally, investment-grade bonds are doing much better than high-yield bonds and Tier 1 capital when markets are in turmoil. But this time around, we're seeing a major shift in global interest rates resulting from big inflation concerns and the fact that global central banks are adjusting their interest rate policy. Global equity markets did comparatively well in the first quarter, but they've also sold off in the second quarter and are now in a bear market across the board. They've all lost more than 20% with very few exceptions. Where we see slightly better performance is in the so-called value strategy. That means global indices or active managers that are using valuations, low valuations, as a matter of investment or as an investment philosophy, where we've seen really bad performance, and this is very disappointing because we've been talking about this many times to you, which is the global quality factor. That means indices or active managers that are selecting stocks based on their earnings quality. That means companies with very high profitability, very good control of their respective markets, quasi-monopolies, but also companies with little or no debt. But it appears that this category or these companies in that factor, they've been a bit expensive at the beginning of the year, and probably also as a function because of very low discount rates, because interest rates were so low. So the discount factor for quality companies was very low, and we've seen a major adjustment in the first and the second quarter. So quality managers as well as quality indices, which we can also see in the performance of the Nasdaq 100 index, they're down more than 25%, sometimes even more than 30%. This is really disappointing, and obviously, it is concerning, although I would argue that there's a reason why these companies have been liked so much in the past, and there's a reason why we continue to like them. We've also seen better developments in China. China sold off a lot at the beginning of the second quarter, but has recovered. It looks like the market is seeing signs of stabilization, more government support. So China is looking better at this point in time, probably also given that valuations are very low. Over the last couple of days, I would argue that the investment narrative seems to be shifting a bit from the fear of inflation towards the fear of recession. And the reason why I'm saying that is because long-dated US government bonds have stabilized materially after being around 3.3% just a couple of weeks ago, they're now down to 2.8%. And that is despite the fact that inflation is still very high. We've also seen commodity prices come off a lot. Just today I've been reading that prices for vegetable oil and other agricultural commodities are also softening, which is an indication that there may really be a recession around the corner, which in turn should result in lower prices. And that is why investment grade bond prices are holding up better. At the same time, we see shifts in equity markets. Commodity companies are suffering again. And interestingly enough, the quality stocks, which we can also see in the Nasdaq 100 index, are holding up better. So it is probably right to assume that some of the losers of the second quarter may become winners in the third quarter. Overall, I would say yes, it's very disappointing. I can see how many of us, many of you are really frustrated and are wondering what we could have done better. But in all honesty, patience is a virtue also in investing. And there are times when markets are really bad and it doesn't pay to be anxious or overly active. Yes, I can argue that, I can feel that some of you may want to trade and transact and hedge and secure, but normally that doesn't help. What does help is combining quality investments in the right portion, and we have developed the Fair Horizon concept for that. That's why I think most of you, as I know, have quality portfolios, everything is in order, and I'm therefore not worried. I can honestly say that the building blocks as we've defined them should all recover. All of them should go back above zero, so I'm not really worried. Where I am worried is some of the investments that millennial investors and some novice investors have taken last year. They've been investing in digital currencies, NFTs, stocks like Peloton and so on. Some of these investments may never recover. So I would really advise against dabbling with these now. They may very well, maybe not go to zero, some of them may go to zero, but just because they've come off so much is not a reason that you should now look into them. Stay with the quality, stay with quality stocks. If you don't like investing according to the quality factor, stay with broadly based index investing. This is something we're also advocating. This will work very well for you. I don't know whether the third quarter will already bring a turnaround or whether we will have to spend the whole of 2022 in the basement, so to speak, sheltering from troubling financial markets. What I can honestly tell you now, valuations are really attractive. Even investment grade bonds with short duration can offer inflation protection for assumed long-term inflation rates of around 2% or a little bit higher. And if you look at global equity markets, we're seeing equity risk premia, which in the past have always delivered returns of more than 6 to 8, maybe sometimes 8 to 10%. Even the so-called quality factor stocks are now offering risk premia of about 6%, which is very attractive given that these companies typically grow at decent rates, and what today is a risk premium of 6% will become a risk premium of 7 to 8% just by waiting a little bit for their earnings to come in. So what I can say with conviction, current prices are attractive. Stay invested if you are invested. If you're looking to invest, don't wait forever. Current valuations are already attractive. Yes, valuations can come down even more, but current valuations are already attractive. Dare to invest. If you're already invested, stay the course. If you feel that your investments may be not properly allocated, have a look at what you have done. Look at your investment time horizon, see whether it is in sync, and only change your allocation if your goals have changed, if your cash flow needs have changed. Other than that, dare to be boring, dare to stay the course, don't be afraid. Things will change, and in the long run, people who invest, people who stay in the markets have always proven to be the winners and could always beat inflation. Please don't hesitate to reach out to us. We're always here to help, always happy to look at your situation, your portfolio, your individual investments, because we really enjoy participating in the markets, even if markets are not always rosy as they were last year and can be really troubling like this year. But we enjoy following the markets, we enjoy our work, and we want to be your coach, your sparring partner. So reach out, we're more than happy to help. I'm wishing you all the best for the third quarter, and hopefully we can see peace in Ukraine.